Hey everyone, today I'm making another valuation video. The stock I want to talk about today is Ingredion. You can see the chart on my screen. One of my favorite websites, stockrow.com. It's free to use. Got a lot of useful information there. So I like to check it out from time to time when I'm looking at different stocks. So really quick overview of this company. So if I scroll down here really quick, you can see here the business profile. But basically Ingredion produces and sells starches and sweeteners for various industries. So it operates in the food industry. It's a food ingredients company, and so it's kind of the raw ingredients that a lot of food companies, processed food companies need to get their ingredients and to make their products. So they are a supplier in that space, and they are growing in the specialty ingredient space, which has higher margins, which is differentiated from the kind of commodity ingredient space that's got more competition and lower margins. And so part of their strategy going forward is to move more into this specialty ingredient space. And if I flip really quick over to their most recent slide deck from a presentation in February, let me just scroll down. I think it's slide 14. You can see they're investing behind two global megatrends: plant-based proteins and sugar reduction and specialty sweeteners. I think it's got a lot of good information in the slide deck. It's on their investor relations site. I thought there was a chart here that showed the growth in this space. Here we go. Plant-based proteins, right? So they're trying to grow from about 37 million in revenue to 130 in revenue in the next 3-4 years. You can see they're doing about 6 billion in revenue. They hope to grow that to 7 billion in revenue by 2024. And you can see that the specialty ingredients are expected to grow to be 38% of revenues from 32% of revenues, but a little less than $1 billion in growth in that area, while kind of the core ingredients, the commodity ingredients, stays about flat. And what they expect that to do is increase their operating margins, right? So you can see down here that the most of their operating income, about 57 to 60%, are expected to come from the specialty ingredients business, even though that is only about a third of the business. And so I think the story here is that move kind of into the specialty space that may have a little bit more of a moat around it. Really quick, going back to this screen on stockrow.com, I like to look at the market cap and enterprise value just to see kind of how big is this company. It's about a $6 billion market cap, 7.5 billion enterprise value. That means it has net debt of the difference between these two, which is 1.5 billion. So it's got 1.5 billion of net debt, which you can see reflected here. It means they owe some money. They have some debt on their books, which isn't necessarily bad. Debt can be a good thing. It can help kind of optimize your balance sheet. So, just like you might responsibly use debt to purchase a home or some other asset where you then only have to pay an interest rate. As long as your return on that money is more than the interest rate, then it's a good move to take on that debt, and especially if you have enough cash flow to cover it safely and you won't get into a situation where you won't be able to make your payments. So this site here is finbox.com. I subscribe to that website. It's a paid service. I think it's about $19 a month for their most basic package, but I think it's well worth it. It can help you kind of assess the value, the intrinsic value of publicly traded companies. So this is kind of the overview screen So those of you who aren't familiar with Finbox, you'll have an overview screen. And over here on the right, you can see Finbox's kind of fair value assessment based on different models that it runs. Doesn't run the same models on every stock. It just kind of depends on the stock and what information is available and what kind of stock it is. So it's selected 9 different models for this particular stock. And you can see kind of based on all 9 of these models, it's assuming a fair value of about $122.05. My favorite model is a DCF growth model. I think that's just based on my education and the way I was taught. I really think that a DCF model for a lot of companies, especially a company like this where we've got kind of stable cash flows, DCF growth exit model or terminal value model is another name for it, is best. I've learned a lot from Oswald Damodaran. I know that's how he values things, that's his preference, and so I've kind of been schooled in that way. So I'm a little biased towards that methodology, but anyway, we can get more detail in future videos on other reasons why I think that's best. But if you look at the 10-year DCF growth model, for example, if I click here, takes me to that model, and you can see this model concludes a fair value of $136, but I typically make a few adjustments when I come in here. First thing I'll do is the discount rate. I'm going to bump this up to an 8% discount rate, and then terminal value, usually do about 2%. Terminal value should be, in my opinion, near the 10-year Treasury note rate, which I think is right now is like 1.7%, so a little bit below 2. But this is kind of the growth that can be expected into perpetuity, right? It's hard to grow faster than the economy. Economy grows maybe about 2% a year. So I've got that adjustment. So drop my fair value down a bit from the 130s to 113, because I've got a higher discount rate and a lower terminal growth rate. But it's still showing it as undervalued at today's prices. So if you look, you can see the revenue growth. Finbox is pulling this information from analysts, I believe, primarily, at least for the first few years, and then has some models to project out, some formulas, algorithms to model out for 10 years. But you can see there's not a whole lot of growth being taken into account. Really we get a bump this year, and then we're kind of 2 to 3%, and then flat at 2% for many years going forward in the next 10 years. And EBITDA margins, does anticipate those margins expanding as it gets more into specialty business. And then we can come down here. You can click on this calculation free cash flow. So based on the EBITDA information up here and some other assumptions that are in these other tabs of, CapEx, working capital, depreciation, tax rate, we can calculate kind of our free pro forma free cash flows for the next 10 years. So you can see currently, last year they did 360 million. This year, somewhere around, a little more than 300. Next year, 400. Then we're getting to 500s by 2024. And then, at the end of the 10 years, we're at a run rate about 700 million of free cash flow, which is the cash that's available for shareholders. And usually that's returned to shareholders in the form of buybacks or dividends. Ingredion does pay a pretty good, maybe 2% dividend, if I remember correctly. And then I like to kind of jump over here. You can see these free cash flows discounted. These are discounted back to present value at the different we had 3 discount rates roughly, but I'm kind of looking at the middle one of that 8% discount rate. And then so the value of the free cash flows over the next 10 years is about 3.6 billion. But presumably this company continues on and is generating cash flows for longer than 10 years. So the value of the cash flows after 10 years is captured in what's called a terminal value number, or right down here. So there's a formula actually for calculating that. Won't go into it here. But you use that perpetuity growth rate and the discount rate, which we adjusted up here in that formula, and we get 5.7 billion. So you add up the 3.6 billion, which is the value of the next 10 years of cash flows, with the 5.7 billion, which is the value of the cash flows after 10 years, to get a enterprise value, which really just means the value of the total business. If you just wanted to, Warren Buffett wanted to go out and buy this, of 9.4 billion. But to calculate the value of the equity, we've got to take into account their debt. And it looks like this Finbox, and I think Finbox is usually a little bit more accurate than some of those websites. If you recall, the website we looked at earlier, Stock Row, was showing net debt of, I think it was showing 1.5. Finbox showing net debt of 2.3 billion. We'll go with this number here. So we kind of got to add the cash, subtract out the debt, and you get this number that's the value of the equity of 7.6 billion, which if you divide it by 67 million shares outstanding comes out to be $113 a share. That's how we get to that $113 share value. So hopefully you followed that, or if you are new to this, hopefully that helps you kind of understand how discounted cash flow valuations work, how you get to the kind of final number. And went through that really quick, but maybe I'll try and include, I think I can include a link to this. Let me just save this. I think I can include a link in the notes below to this model, and I don't know if you'll be able to play around with it, but you'll at least be able to inspect it a little bit closer. Now I want to jump over to the chart. So this is in Thinkorswim. Make this a little bit bigger here. So we've got a daily and a weekly chart. What I like to do is I like to look at the value of a company. I want to find a company that's undervalued by, hopefully 20% or more. I think Ingredion fits that. Still valued by undervalued according to that model by about 20% or so. So once I find a stock that's undervalued, I like to look at the charts because that kind of helps me time my entry. And actually loaded up quite a bit. If you can see back here in November, December, when it was kind of took a little nosedive here into the 70s, I bought a bunch of shares. And he also had another opportunity back in January. I think I loaded up some additional shares. And then they announced earnings, and that's kind of what's given its latest catalyst, where it had some better than expected numbers. And what you want to look for in technical analysis when you're looking at the charts, one of the most powerful things are break and trend, right? So you can see for a long time here, this is over several years, we've been downtrending from this 130 level all the way down, at the bottom of the pandemic, down to $60 a share essentially. And then we kind of got into this wedge triangle pattern, right? We were just kind of bouncing around in here, and things got tighter and tighter, and then we broke out of that triangle. You can see this downtrend line. We broke that, which over on the daily chart is a little bit larger for you to see. We broke through that on this earnings announcement, and then it just ripped from roughly $80 all the way up to 93, and we've kind of just been bouncing around, consolidating. You can see my squeeze, TTM squeeze down here. We're in a squeeze right now, which can signify, once we're out of a squeeze, it can pop again. And so that's what I would hope would happen. We'll see, but it's possible that we're just kind of consolidating here, and then we might break out further. But I'm hoping this is the start of a new uptrend, and that we can make our way back to what I think is fair value, which I said 113. Some of those other models were a little higher, so maybe 120 range. I don't think that is far-fetched for even this year to maybe reach that range. Now I looked. I always like to look at kind of the vehicle through which I make the investment, and I like to use options. If anyone follows my channel, you'll know I like options. I think they're a very powerful tool the right circumstance. If you look at the options though for Ingredion, they're not very liquid. They've got very wide spreads. You can see, right? This is, let me just look here. Yeah, I mean, there's not even bids on some of these. So it was difficult for me to buy any sort of options position. So I just ended up buying the shares. So that would probably be the way I would go with this. But just as a disclaimer, probably should do this at the beginning of each of these. But you know, I'm not a financial advisor. I'm not your financial advisor. This show is for educational purposes, maybe a little bit of entertainment purposes. I don't know how entertaining these are, but hopefully you're learning something, and hopefully this just helps you become a better investor. If you like this video, if you want to see more like it, then go ahead and click the subscribe button, click like. Trying to push out more of these videos more often. Got some sweet software recently to help me do that a little bit more efficiently. So hopefully I can start cranking some of these out. If there is a particular stock that you are interested in, would like me to do a fair value assessment, take a look at it in one of my videos, just go ahead and comment below, and we'll see you next time.